we'll make a start. There may be a few more come in. So what we'll do is make a start now, and I'll start to go through the presentation. So it's in two parts. So I've got a presentation that goes through some of the things that I look for, what the model does. And then I've got the model itself, which I'll go through a worked example so you can see what information goes in and where it goes in and what it then produces. So, and then at the end of that, there'll be a question and answers. So if you've got any questions that you've got, if you can try and leave those to the end, and we'll go through any questions that you've got. There'll be my contact details as well. So if once we've finished today, if you think, I wish I'd asked that question, well, there'll be an opportunity there. Send me an email, send me a WhatsApp, and we'll cover that off. So we will make a start. So hopefully this will go into my presentation. So can everybody see the presentation? Yeah, see if
yeah, I can see. Yeah,
brilliant. So on here,
just a question, Steve. If I may ask, would you provide the slide decks afterwards, or do we need to make notes as we go along?
Well, I'm recording it, Shan, so we'll be able to see it anyway. So you'll be able to watch it as many times over as you'd like.
Okay.
Right. Okay. Well, thanks for everybody for coming along. So I was blown away by the number of people who was interested in looking at this. So thanks for coming over. What we'll do is we'll make a start. And first slide. These are just some of the topics that we'll cover during the webinar. So we've got a little bit about myself and how I've got to where I am today. Not very long, you'll be pleased to hear. Some of the key information that I always request when I'm looking to put together an analysis. We'll go through the process itself. Some of the things to look out for, which you find can sometimes get buried in sets of accounts. Then we'll go into the demonstration of the model. And then there's a little bit there about how we can help you if you need some help. So, without further ado, should be a drum roll here, right? No, anyway, never mind. So my background is, I'm a qualified SEMA accountant rather than ACCA or the other professional bodies. So during corporate life, I worked up to FD, worked in the UK, Sweden, Germany, France, a few different places, and I was part of an M&A team. I always wanted to go and set up on my own by the time I was 40, which I did. So I set up my own company in 2009, and we were providing accountancy and financial consulting services. When COVID hit, I then wanted to sort of go back and revisit M&A because it was something I always wanted to do and learn more about. So I went and did Carl Allen's course initially before going on and doing the Harbour Club course in July 2020. In September 2020, 6 weeks later, I'd bought my first company. I've gone on to buy 6 others. I've sold one of them, and I've done 2 consulting for equity or for people in the Harbour Club whiteboard deals. We've done some this year, we've done 2 this year, and we've got more in the pipeline. The model that you're about to see, I've worked with over 130 clients now to help them to financially analyse their deals. What we do is we provide this for people who may be really good at engineering, healthcare, whatever else it could be, whichever sector you can mention, but finance isn't their strong point. So this is a service that we provide for them. So that's a little bit about myself. So after I've been through a first meeting and you've built some rapport and I'm at the stage where I want to move forward, there are certain pieces of information that I always request from the seller. Now, the key thing is 3 years of statutory accounts, or if you guys in the US, those are tax returns. I'm looking for current year management accounts as well. I'd like to see aged debtors and aged creditors. Now, these can be redacted. I don't need to see customer names or supplier names. It's just really, I'm looking at the profiles here. I'd like to see a fixed assets register, and we'll see why when we go into the example itself. And ideally, I want to be able to see sales profiles and gross margin reports if they're available. They're not always available, but I always ask the question. In terms of the way I then, once I've got this information together, what I then do is we've got a historical analysis. I'm looking at trends. I'm looking at what opportunities can I see to improve this business once I've taken it over. I set a 5-year financial forecasts. What I've produced the forecasts, it allows me to see how much cash the business will generate post-acquisition. If I know how much cash the business will generate post-acquisition, I can then start to look at particular deal structures. So I've got the historical analysis, I've got a valuation, I've got forecasts, and then off the back of all of this analysis, I'm able to then produce a list of any questions that I want to go to the seller with. Anything where there's something that's not clear, or I just want some deeper analysis on particular figures that I see in the accounts. Next, we've got some of the things that I like to look out for, because it's not always clear from the accounts, and there are certain things that can be hidden. Sometimes deliberately, unfortunately, and sometimes it's because of the way that accounts have been presented. So one area is gross margins. And one thing that can often happen, you'll see in the latest set of accounts, stock leaps up. So the stock gets revalued. Now, that's fine, and it may be genuine, but what the impact of that is it will increase gross margins. And that could then, therefore, if the gross margins have been increased, the profitability has been increased, my question is, has that been used to artificially increase the value of the business? Any EBITDA adjustments, earnings before interest, tax, depreciation, amortization, it's something that brokers often will look to do with their information memorandums. I like to scrutinise that, or I need to scrutinise that, and if necessary, I will challenge what those adjustments are. I think one good example, and anybody who's done a deal here, one example could be they want to take out the salaries of the owner. Well, that's fine, but I'm going to put a general manager in place. I'm going to replace one salary with another. So I'm going to be testing, I'm going to be challenging some of those EBITDA adjustments. Well, the overheads, I want to look to see what all the detail is in there. Is there anything in there that shouldn't be there? Personal expenses from the owner. Best one I ever saw was the owners actually charged the cost of an orangery in the profit and loss account and put it under repairs and renewals. 18 grand. You know, it's some of the strange things I've seen over time. When we look at the balance sheet, is where you tend to see other one-line items or one-line entries that we really need to break down. Other debtors can be one, certainly other creditors. If we look at other creditors, these are items that the business owes money for. It could be a director's loan sat in there. There could be other soft loans. There could be other areas that we really need to get a good understanding of. I'm also looking to see what long-term loans there are in the business, because again, that could impact my ability to raise any finance if I need to. So these are all key areas. There are other areas, but these are the key 6 areas I would say that I'm mindful of when I start to analyse a set of accounts. So the model itself, it's kind of come together over a period of the last 3 years, and working with other deal makers, whether it be in the Harbour Club, whether it be Carl Allen's proteges. People have given me feedback and saying, well, it'd be great if it did this, or can you show this? So over a period of time, it's evolved. So we're at version 2.9 now. As I mentioned before, it enables us to produce the analysis, evaluation, forecast, and deal structures. It will also help you to put together business plans if you need to raise finance, and there's also a what-if scenario, which you'll see in a second. So I tend to use it a lot when I'm looking to raise finance. We get some good feedback from finance brokers, banks, and other lenders who like the way that it's presented. Okay, where are we now? We're going into, what we're going to go now is go into the model itself. So hopefully you can all see that spreadsheet in front of you. So the,
Yep.
so the
It's a bit blurry, but it's fine.
okay. So there's a series of tabs which you will see across the bottom of the screen. Anything that you see in yellow is where we can add data in. Anything else is protected, so you can't accidentally type over anything. Some more people coming in, bear with me a second. Right, so in this first screen, we're capturing some of the people, the key person in the business, the name of the business, the year-end date, and the structure of the business, whether it be a limited company, partnership, LLC. We've got all of the key contact information in here. I'm putting in the date of incorporation so that I can see how old the business is. Somebody wants to, let's see if I can zoom in. Oh, bigger pardon, 1 second. Let's go back to that screen there. Now then, I'm struggling to see where I can zoom it in, guys, so I do apologize for that. No, I'll have to move on, I'm afraid, but you'll be able to see it in the recording. We'll zoom, we'll make some adjustments in there for you. Right, I've got in here, I've also got the source of the deal and the sector of the group. Sorry, the source of the deal, so it could be letter writing, it could be from LinkedIn, it could be from a networking event, it could be a referral. So I always put the source of the deal in there. And what I'm also going to actually capture is the sector of the business. So there's a drop-down menu here. So I can select the broad sector. So if I select here retail, what I can then do in the tab below, I can select a series of other sectors. And once I select that one, it gives me the average multiple for that business, for that sector in the previous 12 months. So it gives us a guide when we're starting to look at deal structures. On the right hand side, I've got the shareholding and the types of shares. So it enables me to see, well, how many shareholders have I got? If there are more than 4, I tend to overlook it and I go somewhere else because it can almost be like trying to head fog. You know, it can be quite difficult to get everybody in a room or everybody to agree. So I tend to look at businesses with 4 shareholders or less. Final section at the bottom here, control mouse wheel. Let me just try that. Is that better? Is that getting a bit better for you guys? Yeah, hopefully that's a little bit bigger for you now. So I'm also want to capture the periods of the accounts that I've got. So in this particular example, I've got 22 and 23, 21, 22, and 2021. And then I've also got my forecasting page, which I put in here. What you'll see is these go into the headers of the following tabs that we're going to be looking at. So I'm going to skip over overview. We'll come back to that in a second, but we're going to go into the historical figures. So here, if I just scroll in again, and there we go. Is that okay for everybody? So what I've now got is I'm going to put all the information from the historical accounts into this tab. So we're going to start with the profit and loss account. And I'm keying in for the last 3 years all the information. Now, if I can see, I've got all of the revenues, cost of sales, other income. Now, typically, you will see government grants up to a point. They're starting now. They've dropped off now in later sets of accounts. And I've got all of the detail for overheads. Now, it's important to note, when you're obtaining the set of accounts, there are 2 versions. One, which we send to Companies House for the smaller businesses. One that gets sent to HMRC. And it's the figures that we get sent to HMRC that we want, because they include the detailed P&Ls. And what I'm really looking here are any unusual items of overhead or gross margins. I'm looking at the trends here. So what are sales doing? We can see here they're increasing. What are gross margins doing? Well, we've had a really unusual year there, but overall, yeah, it's fairly consistent. In overheads, is there anything here that I really need to be taking notice of and asking further questions? And so at the moment we've got overheads here up in roughly 400k, and then they've leapt up to 506. So really then, but by putting all of these figures together, I can start to understand, well, where are these increases coming from? Now, straight away, one thing I can see is that the salaries for the directors have gone from that and they've leapt up. And the reason for that is because they've been putting money into their pensions. So if I see anything that will drop out at the end, once I required it, I can put an adjustment in here. And I can make any comments in here that helps me to think, right, I need to go back to the seller and I want to ask this question. I need to understand why this is the case. As we scroll down, one of the reasons that I ask for the fixed assets register is I'm looking at these repairs and renewals here. If we're seeing that these figures are starting to increase year on year, it could indicate that we've got some really old assets. And if we've got really old assets, I need to allow for the fact that I may need to replace them shortly after I acquire the business. So again, I might need to see FAR in there, look at that, and look at the fixed asset register to satisfy myself that these assets are okay, or if they're not, when do I need to replace them? As we scroll down, we've got any depreciation. So, but the key thing here, we've got the EBITDA figures in here, which will form the basis of a valuation, initial valuation. Any interest that's being paid, any corporation tax, and any dividends will also then get entered into here. So now we've captured all of the P&L information. The next stage, we want to do the same thing with the balance sheets. And again, let me just increase that a little bit for you. There we go. So exactly the same principle, but we're really looking to break everything down. The initial balance sheet that you'll see in a set of accounts could be quite basic. So we then look at the notes that follow those schedules to be able to break these figures down. So you can see in this particular example, I've got all the fixed assets and the current assets captured, current liabilities, long-term loans, long-term liabilities. I've got any shareholder funds. And as long as all of these figures here are green, I know that I've captured it and entered everything correctly into my model. Now that we've got all the historical figures entered, we can now start to look at certain trends and ratios, which is what the next tab along does. So at the top here, I'm entering all of the number of employees in the business. There we go. And that's calculating for me revenues per head. As a guideline, I'm looking at a minimum of £100,000. If it's below that, I'm starting to think, well, is there something in the business that isn't running as well as it could be? In accountancy, typically we see something between 60 and 65k, sometimes a little bit less. And that might indicate an opportunity for me to improve that by process automation or improving the efficiency of the business. But down here, we've got a whole series of ratios that help us to understand how well or not the business has performed. If we look at the cash cycle, we can see that it starts to highlight whether the business is collecting cash as well as it could be, or it could be better. So we can see here 49 days, then it dropped, which is in the right parameters, it's under 30 days, and then in the latest set of accounts, it started to increase. Again, it's now going to prompt the question from me, well, why is that happening? So it's something I can go back to the seller with. So we've got all of these ratios that we can use and help us to understand the business. If we've got current year management accounts, we can enter that information into here. Now, you may not get that information month by month, but you may get a year-to-date set of figures that you can use. Once it's inputted into here, it automatically gets populated in this column here. And it helps us to say, well, okay, in this particular, if we look at the gross margins, for example, in the last set of accounts that we've got, 21.9%. For the current year, it's fairly similar, 21.6%. So now we've got all the historicals. We've produced a set of charts here. So if you're looking to produce a business plan or slide decks to present to potential funders, you can cut and paste these from here. Then we can look at an initial valuation. As we all know, a valuation is the right value for a business is what a seller and a buyer agree on. But what this does, it gives us an initial indication. So if I put these figures together, and I say, look, based on what I can see, I'm at £790,000, and the seller thinks, well, I want 5 million. Well, we're a million miles apart, and we don't need to waste each other's time. But in the way that I put this together is that the model will pull through the EBITDA from the analysis that we've done. Any EBITDA adjustments I can put into here, and this could be, for example, the pensions contributions that we'd seen a few minutes ago. And we can also then enter, well, what do I think, what sort of multiple do I want to start with on this valuation? We can see here that the average sector multiple is 3.36. Well, I'm going to start at 3. It gives me an initial enterprise value, but I need to then adjust that for the cash position and any long-term loans that we might have. So the long-term loans are pulled in from the
Recording stopped.
balance sheet. The cash adjustment, the way that we calculate this, I look at 2 months worth of costs from the latest set of accounts, and I compare that with the cash balance in the latest set of accounts.
Steve,
Steve, I think the recording stops. Yeah, sorry.
Well, okay, that stopped on Zoom, but it's still recording on the software that I'm using, so don't worry.
Okay.
So if I look at what 2 months worth of cost look like, and the cash position is lower than that, then I've got a cash deficit. So my argument is that I'm going to reduce the valuation by this deficit. If my cash position is greater than 2 months worth of costs, then I've got a surplus and I would add that into the valuation. So this enables me to get to this position here, 790k. And then I can start to think, well, am I buying, or do I want to buy 100%? Or if I'm thinking, well, I want to leave 20% with the owner as part of a deal structure, I can change that, and it will reduce it down accordingly. Any liquidation value, I put that there just for information purposes. So if the owner says, well, I'm going to liquidate the business, I'll get that, I'll get more than that. Well, my argument is, well, he'll get roughly about 80% of the net asset value of the business. And that will tell you what that value is. Next stage, I've now got an initial valuation. So I'm now going to look at the financing of this deal. I just increase that. There we go. So we've got the initial valuation here. We've got, if you're looking to take any deal fees personally out of the deal, you can put it in there. You can then add in any other costs associated with this deal. Now, it could be the due diligence, it could be the legals. There's something called SDRT, which is you pay the value of the shares that you buy the business for. You'll pay 0.5% SDRT as tax in order to transfer the shares to you. So we've got this valuation here. Now I can start to think about, well, how much am I willing to pay at completion? So for now, we're going to put £300,000 in, and I'm going to say I'm going to defer the rest over 3 years. So the deferred payments would be £163,000 per year. If I need to raise any cash for the deal, I can put it in there, whether it be via property, via inventory financing, or any trade debtor financing. And what it will then do over here, it will work out what those repayments are. And those repayments appear here. So, what we don't know now is how affordable this deal structure is. at this point. So now we're going to go into the forecast. So everybody okay so far? Does anybody want to ask any questions at this point? Because I know I've gone through quite a bit of information. If you just want to mute yourself and just ask away. No? Okay. Here's our...
Yeah, I have
Sorry,
a question.
I'd have a question.
Yeah, sure.
Where do we? Yeah. Is there anywhere where I can find this file? The Excel.
Sorry, the file?
So, yeah. Is there anywhere I can find this file, or is it your custom-made file?
This is my
Sorry,
custom-made file. So you'll be able to get access to it at the end of the recording. I'll show you how we can get hold of that.
All right. Appreciate it. Thanks.
Okay.
Steve,
Yeah.
can you hear me?
Yeah, I can.
Hi, it's Luis. I just wondering, which source do you use for the business sector average multiple? You know, when you said you use 3.6, what's the source you use?
Yeah, that's bizbuysell.com. It used to be freely available, but I think now they'll charge you for it.
Sales?
Bizbuysell.com.
Bizbuysell. Okay. All right. Thanks.
Okay. Everybody else okay? Great. Okay. So what we've got now, here are our 5 years worth of forecasts. And we can see here the previous set of accounts that it's pulling through for us to give an assessment of how we're going to grow this business. Now, the way that I approach this is I produce conservative forecasts, because if I can make a deal structure work with a conservative forecast, then anything over and above that, anything that I do once I own the business by introducing new revenue streams or reducing any overheads or increasing margins, whatever it happens to be, then that's all upside. So I produce a very conservative set of forecasts. So we can see here, we can enter the growth assumptions for revenue and overheads. And it will calculate everything in here. Now, the cells are yellow because you can over type those if you're wanting to. Here, I then look at what assumptions am I going to make in terms of gross margins. So I will look at the last 3 years of accounts plus the current year management accounts, and I'll take a view. If I see that margins are falling, I'm going to take the last set of figures that I've got. If I see that the average is a little bit better than that, great, I might be prepared to nudge this figure up a little bit. But in this particular example, we've got gross margins of 21.9%. I'm going to forecast 22% for the next 5 years. I'm then going to start to look at, well, what else am I going to be incurring in terms of overheads? In here, I'm putting in an assumption as part of a handover for the outgoing sellers. I'm also looking at, well, what any new orders fees if it's for me, or if it's for me and a joint venture partner, what sort of fees are we looking to take out of the business? And then we can start to look at all of, it's going to calculate for us all of the other overheads. As we scroll down, there's a section in here where we can put any additional staff that we may want to recruit in the business. So a typical one could be general manager, it could be additional administrators, it could be a business development manager, and we can then make assumptions on what we think the salaries will be and when we want to introduce them during that 5-year plan. Last section on this screen is capital expenditure requirements. So if we've looked at the historicals, and we can see that we've got increasing repairs and renewal costs, and we also know that we're seeing the fixed assets register, then what we can then do is plan for any additional gross margins, and any additional fixed assets that we may need to purchase. Now we've got this particular this forecast done, we can go back to our business valuation, financing the deal tab, and we can see here how that impacts on everything. So we can see what the cash position is going forward. That enables me to then start to play with a deal structure. So I might think, well, okay, we're looking at these figures, I may be able to defer over 2 years. and the cash still looks okay. What we're also looking at here, just below, is a payment cover calculation. So whenever you approach financiers, they'll look for at least 1.5 times EBITDA, something called debt service cover ratio. So as long as those figures are green, we're happy. We've got some really healthy figures in there. And if the owner comes back and says, well, 790 is okay, I'm looking for 900. Well, what we can do is start to add figures in here as part of an earnout. And we can see that as we go through, these closing cash position figures are healthy enough to be able to nudge that figure up if we're wanting to. So we've got a deal, we've got a valuation, we've got a deal structure, and we've got our forecast in place. What we've also got, we can play with any working capital assumptions. So we can, in here, let me just adjust that, there we go. So we can look at the historical debtor days, inventory days, and creditor days, and we can adjust. So if, for example, if debtor days were really high, and we think, well, actually, I've got a team in place who can sort this out. You may think, well, I can reduce these debtor days accordingly. And as you reduce these figures down, it will adjust your cash figures below. Same thing for inventory days. If you think you can make improvements, you can adjust for it here. And also creditor days, you can make further adjustments here. That will filter through into a more detailed, let me get that right for you, more detailed financial forecast. So we can see opening cash position, so we can make an assumption for what our opening cash is going to be. We can see all the EBITDA figures that we forecasted, less the corporation tax. If we switch on the working capital assumptions, it's here, and it will just pull it through. Or if we want to ignore that for the time being, we can ignore it. All of our capital expenditure figures get pulled through, and our deal structure as well. And we can then see the cash position. So we've got, what we can now see is that this model, if you was to put that in front of a financier, in addition to the historical accounts, and in addition to any business plan you might have, this will give them everything that they need in order to be able to evaluate whether they're happy to put some finance into this business. If two other slides we've got, two other figures in here, we've got a slide deck tab, which will enable you to cut and paste these into a slide deck or a business plan. And you've also got a what if scenario in here, so that if you know the revenues for the business in the latest set of accounts, you know how many invoices are being produced and how many customers, it will calculate the average sale and the frequency per customer, and then you can start to play with that as well. So if you say, well, actually, once we own it, we think we can increase it by actually 10%. This we can increase by 7%, and that by 12%. What it's done, it's recalculated your P&Ls and your balance sheet. So you can see straight away the impact on cash. So this is everything that the model does. Okay, any questions at that point?
All good.
Yep, okay.
One from me, Steve. I may have missed it, but was there a place, if you're paying if you're financing the advance consideration, was there a place for the interest costs on that?
Yeah, so the interest costs are all calculated as part of your cash flows. So if we go back to the financing the deal tab, all of your assumptions are in here. So if you know the loan term, the interest rates, so if we look in here, for example, this particular deal, they'll only extend it for 4 years, but it's going to cost us 18%. Well, you can see straight away, it's recalculated what those loan repayments are. Okay.
Can I also ask a question? How do you decide how much working capital will be left in the company on day one?
Well, this is where I look at 2 months worth of costs in the business. And that's as a general guide. Rick Smith's on the call with us today. We're looking at one where we calculated at a particular level, which is about 180k. The seller's accountant calculated at 40, so which was bizarre. It was really low for the business that we're acquiring. But it gives us what we can do if we know what 2 months worth of costs are. That gives us a really good indication that if sales fell off a cliff, we get another lockdown, wherever it happens to be, we know we can run the business for another 2 months before we really hit problems. So that's the way that we look at how to calculate it.
Thanks.
Okay.
But you don't look at the working capital for 2 years? With all the monthly management accounts and bank accounts?
I take the latest set of accounts and I look at what the 2 months worth look like in terms of what we've actually seen historically.
You look at for 2 years?
No, for 2 months, not for 2 years. So it's just the last set of accounts that I look at, the last one financial period.
Okay, because it can change very drastically if it's only 2 months.
Yeah, but I'm looking at this as a guide. So if you look at 2 months worth and it drastically changes in the current year's management accounts, well, maybe you'll adjust it. So if you've got the last set of financial accounts and the current year's management accounts, you can take a view. But at least everything's captured in here to allow you to make that assessment. Okay.
Hi, Steve.
Yeah.
Great model. Thanks very much. Just a quick question. I can't see the tabs at the bottom. I presume this might still be coming, but I just wanted to know, does the model also calculate the opening balance sheet with the SPV and then also a consolidated version of group plus trade code?
Not at this stage. There's no reason why we couldn't do something like that in a later version. We're always getting feedback from people, so we don't produce that at the moment. What we can do, we've got the cash flow forecasts, which we can see in here on this one. So we can, we've got our opening cash position here, and because we've produced a forecast and we've got a cash flow, and we can produce a balance sheet from here if we needed to.
Yeah. So just when you're going through financiers, they always request the SPV portion later stage. So yeah, that's great though. Okay. Thanks.
The only other one that I haven't shown is in here as a guide. We've got an offer sequence, and again, it's just sometimes it's helpful that you might have an initial offer that you put into the seller. If that gets knocked back, then wait 3 or 4 days, go back with the second one. So this gives you a very high level what you could be offering in subsequent offers to the seller. Right, let me go back to my presentation as soon as my screen comes back on. There we go. So if I want to go on to next one, bear with me a second because my screen keeps going black for some reason. There we go. So give me a second, guys. Multi-screen there. Right, okay. So if I go back onto just that one, hopefully you'll get my face. Is that okay? Can everybody see me?
Yeah, got you, mate.
Brilliant. Okay, so that's the model. So as I mentioned before, we do work with people. If anybody needs some help with this, there's 3 ways we can look at it. We can provide the model for you. And then what we do is we have a follow-up call to show you the model in more detail. So we'll have a one-to-one call where we'll do an hour's training, and then you get support after that. There is a done-for-you service where if anybody thinks, well, either I've not got time for it or this just isn't my thing, we will do all of this analysis for you, and then we'll also produce a written report that gives you what we like, what we don't like, all the red flags, and a list of all of the questions that we'd be going back to the seller with. So there's a done-for-you service, and then there's one where we can say, look, we'll just hold your hand through the whole process. And depending on how you want to run with this, there's we can provide that for you. If you want in the model and the support and the training, then we do that for 395. If you want in the done for you service, it's 795. If you want in everything in there, it's we do the analysis, we do the heads of terms, we do the due diligence for you. You know, we've got a service that we can offer as well at 1695. Any questions, guys?
Too cheap, Steve.
Story of my life.
Sorry, can you repeat the figures, please, because we couldn't write them down?
Yeah, of course. So there's a slide here, and you'll see if I just go through onto my presentation and go to the onto there and go one further on. There we go. So those are the three levels of service. So if it's just something that you want to be able to do for yourself, you'll get a copy of the model, and any subsequent enhancements that we make to the model, you'll get free of charge. So when Mark mentioned there about looking at balance sheets, yes, we can add that in, and as we make those adjustments, we'll make sure that it gets emailed out to you. So you'll automatically get an updated version of the model. We'll do that one-to-one, where we'll spend an hour. If it's longer than an hour, that's fine, whatever it takes. If we need to adapt it for any reason, so we have a US version of this model, for example. Unlimited support, so there's no such thing as a daft question. If you're going through it and you think you get really stuck, just send me a WhatsApp, send me an email, we'll jump on a call together and we'll go through it. You know, if you've got something partly populated, we'll go through the rest of it together. So that's what that do-it-yourself service is. The Done For You one, we're going to do all of that analysis. We'll do all the analysis, the forecasts, but what we'll also do is work on those forecasts to produce more than one scenario. So I'll produce the conservative version for you, and then we'll work together to say, well, actually, I know I'm going to do this, 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 and this with the business, and then we'll create a version 2 or a version 3 or a version 4, so you can then think, well, I've got a worst case, a best case, and everything in between. So we'll work with you on that. We'll look at all the valuations and the deal structures together. We'll produce the report, which you will get in PDF format. We'll produce a list of all of the questions for the seller, and that will relate to the P&L. It will relate to the balance sheet and anything else that we see that we think, actually, don't forget to think about this. So that is the Done For You service. Then on the works, I don't know why I come up with the works. I must think of a better name for that. It's rubbish, isn't it? I know. That's the accountant in me, I guess. So in the Done For You service, in the work service, it's everything that you see in Done For You. And then you also see, I can attend the calls if you'd like me to. We'll draft the heads of terms. We'll produce a business plan. We'll support you in raising the finance and the one-to-one support. So that's the 3 levels that we offer. So it depends on what you prefer to do. That's there for you. Any more questions?
Can I just say, everybody, that I've been working with Steve now a while, and when we send this out to funders and even people who are looking to acquire the businesses from, they're blown away with this. And I was, back to what I said earlier on, I wasn't joking. It is too cheap, Steve. I mean, for what the value you get for that, it opens doors. So I just wanted to put that out there.
Thanks very much, Rick. I really appreciate that.
You're welcome.
So if you want to get the do-it-yourself version, if we go to my next slide, beg your pardon, let me just go back onto that one. There we go. So if you scan any one of those, the first one takes you to the model itself, so you can buy the model itself. The Done For You service, if you scan that one, we can book some time in the diary, so we can talk through what it is, the opportunity that you've got. Or the other service, the work service, then you've got that one, scan that particular one there. So whichever one, if any one of those that are of interest to you, scan those and it will take you where you need to go. Any more questions, guys, before we wrap up? If you do think of anything afterwards, you've got my WhatsApp will be coming out if you haven't already got it. You've got my email address in this presentation. So send me a WhatsApp, book into my Calendly diary. or send me an email, and we can go through any questions that you might have.
Hi, Steve.
Yeah.
Just a quick one. Let's say we went for the full Monty package, the works, and let's say we went for the business plan, the DD, etc. What's your typical turnaround time surrounding that?
Well, for the business plan we can produce in 48 hours.
Okay.
Due diligence typically takes a week, but that's really constrained by how quickly the seller puts everything together in the data room for us. We'll set up the data room. We've got a due diligence questionnaire that we provide, and that covers 16 different areas of the business. So it's pretty comprehensive. Once everything's populated, then we'll go through that with you.
Okay, thanks.
I've got a question. How does this software compare to Jeremy Harbour's software that's on the Harbour Club? I forget the name of it.
I'm not sure. Well, there's something called Valitour.
That's the one, yeah.
Yeah. Okay. Well, Valitour. You see, it's a tool I use myself, and it can be quite useful if you've got a seller that has particular expectations about what the value is of their business. So you ask them to complete it. It's almost like one of Dan Priestley's scorecards, and then it takes them through a series of questions, and it will produce a report that says, based on what you've told us, this is where we think what the business is worth now. But it will also then go on to say, well, if you do this, this, and this, you could increase the value. It doesn't necessarily do the more in-depth analysis, but it helps to sort of bridge the gap between what you think the business is worth and what the seller's expectations are. But it is a good tool. I've used it
a
myself.
different thing, yeah. Okay. Thanks.
Okay. Anything else, guys? No?
I really appreciate it, Steve. Thanks very much.
No problem
Thank
at
you.
all. It's good to see you all on the call. So, like I say, if you've got any other questions, then send them through, and I'll be happy to help.
Sure. Thanks
Thanks
again.
very much, Steve.
All right.
Bye.
Thank you, guys. All right. Goodbye.
Cheers, bye.
Thanks, Steve. Cheers, mate.
Thank you.